A European Union possible ban on Russian energy supplies is keeping markets on edge. This does not allow oil prices to fall significantly. So it comes as no surprise that after dropping to almost $100 per barrel, the quotes resumed their rally. Moreover, the German Foreign Minister added fuel to the fire. German Foreign Minister Annalena Baerbock said yesterday that Europe's refusal from Russian oil and gas imports is inevitable. True, she did not specify when exactly this would happen and whether such a clause would be included in the new package of sanctions Brussels is about to adopt. This in turn leads to mounting worries in the market. After all, some European countries are determined to immediately follow a move to cut off Russian oil imports. In case this requirement is violated, Europe will impose sanctions. In general, market participants are highly concerned about a possible global energy crunch, as Russia is the world's largest supplier. Apparently, until the European Union publishes a new package of restrictions, the market will continue reeling, depending on the statements of various European policymakers. At the moment, their tone contributes to higher oil prices. According to the trading chart, Brent crude oil futures have lost 10% since the start of the trading week. As a result, the quote returned to $100 per barrel. At that level, the volume of short positions decreased, which resulted in a price rebound. If the price consolidates above the 107 mark, the trend may change to bullish. Until then, the downtrend will be considered relevant in the market. On a Friday, the ruble left for a long weekend with losses, and the US dollar seemed to be about to rise above the level of 70 rubles. However, the Russian currency kicked off today straight with gains again, and this is largely due to the situation in the energy market as well as the expectations of an embargo on Russian oil and gas supplies. After all, in Europe takes this step, the world economy will instantly face an energy crisis of unprecedented proportions. Other countries will try to fill the gap by all means, primarily by purchasing oil and gas from Russia, including for rubles. And this is what contributes to the strengthening of the Russian currency. So, as in the case of oil, much now depends on both the sixth package of European Union sanctions and the statements of European policymakers. At the moment, all this acts as a driving force behind sustainable gains in the ruble. Gold seemed to be gradually paring losses incurred amid the US Federal Reserve's decision to lift its benchmark interest rate to 1% from 0.5%. Currently, the yellow metal is trading in a modest upward trend. The level of $1,830 per 3 ounce acts as a variable support. In late afternoon trade, gold may well gain upside momentum and return to the market of $1,900 per 3 ounce. The reason for its rally could be data on inflation in the United States. After all, the April reading is forecast to moderate to 8.1% from the 8.5% year-over-year pace of March. That's inflationary pressures in the US economy should ease, and notably aggressive monetary policy tightening by the US regulator was caused by the surging consumer prices. In other words, if inflation does slow down, the Fed may consider pausing its interest rate increases. This will result in a weaker greenback and accordingly higher gold prices. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.